everybody. Good evening. Welcome to our next presentation with our subject expert, Kenneth Royster, on insurance. We hope that you all are coming in. We hope you're coming in and hope you will enjoy this presentation. Make
Well, let
sure
me
you come in and like and share if this will be good for you. So we want you to come on in. Pastor?
So good evening, everybody. Welcome again to Pathways to Peace. Let me just say thank you to Reverend Patricia Sims, who really was the midwife of this whole ministry. She took it and ran with it as she is so able to do. And so because of that faithfulness and skill, we are here tonight with our guest for the evening, who is somebody who really doesn't need an introduction. When he opens his mouth, believe me, you will be introduced to our subject matter expert, our scholar practitioner, Brother Kenneth Royster. He is not only a decades-long friend, but he is an apex practitioner in the teaching and generation of wealth, as well as managing wealth himself. He is a maker of millionaires, I can say without contradiction. He is somebody whom, if you take his advice, you will never regret what you have done. I can faithfully say, without fear of contradiction, that everything Dr. Wanda and I have is the result of the stewardship and the listening ears of Ken Royster to the Holy Spirit, but the skill also he has accumulated over all these years. He is a faithful, dutiful, powerful practitioner of everything you're going to hear tonight. And so you need to, as Reverend Sims has already said, share this, go tell others, go on and get in this meeting. If you can get into Eventbrite, it's free. Tell a friend, tell a neighbor. Let's get ready for Pathways to Peace this session with Brother Ken Royster. God bless you.
Thank you. Thank you, Dr. Weary. Thank you, Reverend Sims. To the listening audience, again, it's great to be here. It's great to get an opportunity to present to you once again. You may recall in our last meeting, it was a big overview of a lot of things that are required in order for you to achieve your financial success. But tonight, we're going to narrow it down to one particular topic, and that's in the risk management field. So if you'll bring up the slide presentation for me, we can go ahead and get started. So again, this is insurance strategies for preserving and growing generational wealth. Next slide, please. So there's been some interesting studies that have been put out as it relates to African Americans. And some of it is very disturbing. This one is one of the most disturbing, and that is this notion that by 2053, that Black households will have a median wealth of zero. Now that's for some people that's impossible. Well, remember, everybody ain't the same everywhere. So if you kind of look at the United States, for instance, 82% of African American wealth is concentrated from New York City to Florida. Think about that. There's 50 states, but 82% of the wealth for African Americans is between New York and Florida on the East Coast. That means 18% is spread out between Texas, Chicago, Detroit, St. Louis, Los Angeles, Oakland, San Francisco. Major metropolitan areas is where most Black folks live when we think about large populations. But guess what? We forgot about places like Arkansas, Kentucky, Tennessee, Iowa, Kansas City, Kansas. Black folks are all over the country, but guess what? We're all not living in these urban hubs where there's good paying jobs and a lot of affluency. That's not the case. So when you kind of put that together and you couple it with 400 years of oppression on top, you can clearly see how easy it is to go from right now. If I told you, still wouldn't believe me, but I'll tell you, do your own research. The average net worth for blacks in this country is $1,700.
Wow.
So do your own research and refute it if you like, but that's the average. That means that most folks don't have any money. And then there's another gap. You hear people talk about closing the racial wealth gap. Well, there's also a wealth gap within the Black community, going back to those 82 percentile people on the East Coast versus everybody else. Now, as I said, you go to California, you think about entertainers and athletes. But what about regular working people? Are they living that well in California? California's got one of the highest tax bases in this country. And we already know that those with less pay more in taxes than those who are rich on a percentage basis. So there's a lot of things to be said about that. So folks will say, well, Ken, why are you even sharing that information? If we're talking about accumulating wealth, because it's important that you get on the right side of it. Get on the right side of the zero. Don't be zero or less. Be a positive for you and your family and start doing things that will empower your family so that this is not the case. I was at an event this weekend, and one of the things we were talking about was how come some family members are always asking other family members for money, and the other ones already have it. How that happened if they all grew up the same? Well, they made different choices. Different people make different choices on how they spend their money, and those who decide I'm going to save more and spend less end up with more later. It's just as simple as math. Okay, next slide. Other way. There we go. Oh, can y'all hear me? Uh-oh, somebody muted out. I don't know if you can hear me or not. All right. Somebody come back on. Let me know if they can hear me.
We can hear you.
Okay, thank you. Because it went totally deaf, and I said, "Whoa, did something happen?" Okay. Can you blow my slide up a little bit more? A little bit more. Can you make it a little larger? The slide. Okay. So prepare for the future. Look forward with confidence. Again, as you think about all the things you want to accomplish in your life, as it relates to finance, do you really have a game plan for it? Have you sat down and actually started mapping out a strategy? Part of my conversation in the last session was about that, about getting yourself prepared to meet your future. And your economic future requires a lot of attention. Next slide. So with that being said, I shared with you all in the last session that there are 6 areas of financial planning. The first one is financial position. That's dealing with managing your debt and your cash flow. Okay, that's the very basic thing. If I don't have a good budget, I can't invest any money because I don't know what I have to invest. 2, if I'm overspent, I'm going to end up in debt. I'm going to end up borrowing money and I'm going to not win. So those are the things we want to do. Today, we're going to talk about the risk management, the second level here on of the 6 areas of financial planning and the second level of the 6 areas on the financial pyramid. Next slide, please. So, risk management. Your financial planner will help you analyze your situation and help you find ways to protect your income and assets. Today, we're going to focus on 3: life insurance, disability, income insurance, and long-term care insurance. But there are 2 others that I'm not focusing on tonight, but they play a big role, and that's health insurance and property and casualty insurance. We'll get into those in another session. So if you look at the circle there, you start off with what? Identifying your risk, saying what things can go wrong. Well, when we talk about life insurance, disability, and long-term care, that's dying, that's getting injured or sick and can't work. And long-term care is basically I can't take care of myself because I had either an injury, illness, or I got too old. And what's my strategy? Okay, that's the assessment portion of it, is what's going to happen if one of these bad things happens to me. What do I have in place? What have I put in place to protect myself? Now, there was a term years and years ago that people used to call, I can't buy insurance for everything. I'll be insurance poor. Very true statement. Very true statement. But part of the assessment process is prioritizing what's the worst thing could happen to me. And if I don't do anything, I want to protect myself against the worst thing that could happen to me. And then start looking at which direction I'm going to go in. And that's where the analysis comes in next. Analyzing these particular risks and making sure that I understand them and I bought into the fact that I need to protect myself against some of these risks. That's decision making. That's really the hardest thing. I tell people all the time that with life insurance is one of those things, particularly, is a sacrificial gift. When you pay a premium on a life insurance policy, you're actually paying for somebody else to get a benefit if something happens to you. The other two really pertain to you. The disability insurance and the long-term care insurance really pertain to you. But the life insurance is something that's going to benefit somebody else. So I got to care enough about somebody in order to even buy life insurance. And that's one reason why you see a lot of folks die without it. They don't really care enough about the folks they're leaving behind to even contemplate paying a premium for it. Sounds a little harsh, but it's a reality. Me and my daughter talk about it all the time. We get so frustrated when we see a GoFundMe go up for somebody after somebody dies. And we go, what? You didn't buy any life insurance? Nobody bought life insurance? And now they want to do a GoFundMe to pay for this person's funeral? We should be past that in our economics. And the last part here, last two parts is implementation. That means putting the insurance in play. You buy a policy, you keep it until the event happens. You don't cancel insurance policies before they pay off. The insurance company only wins when that happens. So let's make sure if we buy a policy, we're committed to the policy to do what we say we wanted it to do. Now, some folks will say to me, well, Ken, we know what happens with life insurance, but what about this disability insurance and long-term care insurance? What if I never have one of these events happen? How does that work out? Well, I'm going to talk about a little bit about that today, how you get money back off of some of those type of contracts as well. And the last piece is monitoring. And again, that's making sure that your insurance is current, that it's enough to meet your needs. Example would be somebody 25, 30 years old might have bought a policy for $50,000 or $100,000 20 or 30 years ago. Now they're 50 years old, and that amount of life insurance is really not a lot in today's time. They should have upgraded that insurance along the way as their income went up. Certainly some of their expenses went up, and their overall desire to make their family better off has probably increased as well. All right, next slide. So when we talk about life insurance, okay, there's really several different types of life insurance: term life insurance, whole life insurance, a blend of term and whole life insurance, and then you have universal life. And even on the universal life, there's three different types of policies. You can buy a guaranteed universal life. The big buzz nowadays is called IUL. IUL. That's indexed universal life insurance. And then there's variable universal life insurance. I'll spend a minute a little bit later talking about this index and guaranteed under the same banner of universal life. I'll just say this. buy some life insurance to protect your family. I don't care which one of them it is. Buy one that fits you, and we'll talk about that a little bit later. Next slide. So, life insurance policy terminology. This is really, really important because a lot of times people don't know where they stand on a policy and why it's important for a person to be positioned differently. So let's start off with the policy owner. The policy owner in a life insurance policy is the strongest position in the policy. This is an individual or an entity that maintains the policy. This is the person who pays for it and monitors the policy owner. Some people think that the insured is the strong position. Well, the insured and the policy owner could be one and the same, but sometimes it's not. There's a lot of times where I've told husband and wives that they should be opposites. That means the husband should be the policy owner of his wife's policy, and the wife should be the owner of her husband's policy. And you say, well, Ken, why would they do that? Because human beings are interesting people. Sometimes people cancel insurance and don't tell their spouse. Hello, lights. Amen, lights. I've seen it happen where one person canceled a policy on their own life as the policy owner, didn't tell the beneficiary who was their wife, and they died. And the person shows up with a policy and we have to tell them that policy was canceled. And they go, what are you talking about? Yeah, your husband canceled that policy 5 years ago. And the person is in shock, stunned. They said, he never said that to me. And now they need that benefit and it's not there. Haven't seen it with a woman yet, but I've seen it with men. But nonetheless, I still tell people that if you're married, let the other person who's the policy owner and the beneficiary be aware of what's going on with that policy so they don't get caught unaware. So the beneficiary naturally is the person who's going to get the benefits from the policy. That's who's going to collect when somebody dies. The next line here is contingent beneficiary. I recommend, again, that everyone should have a beneficiary and a contingent beneficiary. Why do you say you need a contingent beneficiary? Because if the primary beneficiary dies and there's not a person named as number two, then who's going to get the benefits? You can find yourself in court with people saying that they are entitled to a benefit because they were related to the beneficiary, but it might not have been the policy owner desire for someone else to benefit. I've seen that happen. I've seen it happen with a couple who had no children. They had each other as beneficiary. And on the second death, they forgot to change the beneficiary from the one who had already passed. And a relative who they didn't even really like that much was the next heir in line, and that person got the benefit. These are the type of things that bring people to a lot of ire when they look at insurance. They say that wasn't a good deal. They didn't think it was fair. And they might even be mad at the insurance company for it. Well, it really wasn't the insurance company that did it. It was the policy owner who failed to put a contingent beneficiary on that policy to say who would be next on that policy. And the other thing I would share with you about beneficiaries is that it doesn't have to be one person. You can have as many beneficiaries on a policy as you want. You just put down the percentage you want them to get. Example, you buy $1 million policy, you got 10 relatives, you want each of them to get $100,000. That's 10% each. Pretty simple. I'll make it a smaller number, say it's 50,000. Okay, each of them going to get 5,000. But it's up to you. You can do that. They don't have to even be equal. You can say one beneficiary is going to get 50% of the money and three others going to get 15% or 17% to make up the difference. It's up to you to decide that as the policy owner. as the policy owner sets the beneficiary designation. This last bullet here is called an irrevocable beneficiary. This is one that you should not be using unless you have a trust document in place for it. This is an absolute designation, and it cannot be changed even by the owner once it's set. An irrevocable beneficiary means it can't be revoked. A designated beneficiary of a life insurance policy that cannot be changed unless it's given by the beneficiary themselves. Now, you tell me, if I'm a beneficiary of a life insurance policy, I'm going to tell you to change it to somebody else's name? No chance. No chance. Okay? So, again, if you're not sure that you want to make somebody an absolute beneficiary, don't use irrevocable. Okay? In my career, I've seen times where people who've gotten older had grandchildren that were beneficiaries of the insurance, and they changed it every 2 or 3 years. Why? Because some of those grandchildren wouldn't come visit. And they said the one who visits the most is the one who should be getting the most. So they change it and make that person get the lion's share of the policy when they pass away. This is all personal decisions, no right or wrong. But what we want to do is make sure that you're armed with the information so you know what to do. Next slide. All right, so term life insurance. Normally a term policy can be 10 to 30 years of a level premium, okay? It'll offer you the right to convert that policy to what they call a permanent plan of insurance, which are what the other plans are. So this is term, just like it says, for a specified term, 10 to 30 years, okay? No cash value, doesn't build up any cash value, but there are some policies now that offer what we call a refund of premium that says if you buy a term policy and you keep it a certain number of years, they'll give you a refund back on that policy. Well, that policy is going to cost more than a traditional term insurance policy because they've got to give you the money back. So the insurance company is going to charge you more. You kind of look at that and you said, well, I should have just bought a permanent plan of insurance and avoided that. But again, it's buyer's choice. Everybody's situation is different. And so therefore, we don't tell any person that one shoe fits all. You need to sit down with your financial advisor and say, which is the best policy for your situation? And then make that decision. Next slide. Whole life insurance. Everyone's generally familiar with whole life insurance. Pretty much you're insuring yourself for your whole life. Okay, it's a permanent plan of insurance, and again, you buy it, you pay one rate, and you pay that rate until you die. Okay, now it's permanent. It has a cash value accumulation. That means it builds up money in the policy. It has a fixed premium. That means the premium is never going to change. Unlike a term, when that term is over with, you're going to get a new premium rate. You're not going to get the same rate because you're older. You also have the right to elect how you pay for a whole life policy. You can pick a 10 pay, means you pay premiums for 10 years and it's paid for, no more premiums. 20 pay, 20 years, no more premiums. Pay to age 65 or pay to age 100. Your choice. These policies are available to you from various different carriers. It's just up to you what fits your situation. Next slide. Universal life, as we spoke earlier about these three main types of universal life. They're just like a whole life policy, except for what we call they're a little unraveled. That means they're permanent coverage. They can accumulate cash value, and the premium and death benefits are flexible. Okay, that's what the difference of the whole life policy is. The premium and death benefits are not flexible; they're fixed. So when you buy the plan, you got a benefit, you know what it's going to be. With a universal life, you can tinker with it. You might have a policy for 5 or 6 years and decide, I want less coverage and I want to pay less. So you can reduce the face amount down to a lower amount. Danger with that is if you change your mind and want to increase it back, you got to go through medical underwriting again to increase it back. So that's the danger with that. The other thing is with premiums, you could actually reduce the premium and not reduce the face amount. But in doing so, in the later years of that policy, because it has an internal mechanism for the cost of insurance, you may find yourself having to pay more. There's probably at least one person that's watching this right now who might already have been in that situation where they bought a policy at one rate, reduced the premium because they were having some economic challenges, never changed, came back and increased that premium back to the level it was supposed to be. And then 10 or 20 years later, the insurance company wrote them and told them, hey, you got to pay more money to keep this policy in force than what you're paying right now. And they generally don't even like the number that they get at that point. They wish they would have been told earlier. But again, they weren't engaged with their agent on that policy like they probably should have been, or the agent wasn't involved with you as a client as you should have been. And therefore, you were in the surprise mode about how this policy works. You enjoyed the flexibility, but it has a downside to that flexibility. The Index Universal Life, what's making IUL so popular today is because of the stock market. It basically says, here's a product you can buy, an insurance that supposedly will mirror the stock market, but at the same time, you don't take any losses against the stock market. That's a pretty good deal when you hear it. The problem is in the contract being that it doesn't go negative, it also has a cap normally on the positive. Means you can't make but so much money. Think about being fair. If you're an insurance company, why would I give a person a contract where they can't lose any money, but they can make as much as the insurance company makes on the same contract? That means they absorb all your losses and you get the benefit of all the wins. I'm afraid they ain't going to work that way. They're going to cap your winnings and they're going to take the difference for themselves. So there is some risk in that. Same thing again applied, as I said, with the Guaranteed Universal Life, where you have a premium, you have the flexibility of changing it, but at the same time, be careful about reducing premiums and not repaying those premiums back to maintain that policy at a certain level. I didn't mention, though, earlier on the Guaranteed Universal Life, you can actually buy a Universal Life, Guaranteed Universal Life, that actually mimics a term policy, where you can set a predetermined period, whether it be 20, 30, 40 years out, or up to a certain age, 100 to 121 years old, where you just pay a premium and you know that you're not ever going to have to pay more than that for the coverage, no matter how old you get. And that's a really good contract, generally for those who are coming off of a term policy after a 10 or 20 years period and saying, I can't afford a permanent insurance, but I want to still maintain my coverage. Well, buy a Guaranteed Universal Life. That way, you know that policy will be enforced until you die. Specifically, if you don't have the money to buy a whole life policy or a fully fund a universal life policy. The last one on here is the variable life insurance policy. This is where, again, I'm invested in the stock market with my underlying investments, but guess what? No caps. And the same thing, no protection on the downside against negative turns in the market. You would say to yourself, well, index, variable life, they sound like they're the same. In a way, they are the same, except for one limits your losses and limits your upside. The other one doesn't limit your losses and doesn't limit your upside. So depending on who you are as a person and what you're looking for this policy to do, either one will fit you based on you. Next slide, please. Factors to consider when evaluating how much coverage is needed. That's a famous question that we get. Ken, how much life insurance should I have? The easy answer, if you care about your family, okay, is that you should be able to replace at least 10 times your annual income. So if you make $100,000, you should have at least $1 million of life insurance on your life. If you make 50, you should have at least 500,000. Then there's a couple of other caveats. You definitely want enough to pay off a house. If you married okay, and you have a balance remaining on your home, you want your spouse to inherit the house free. So you write enough life insurance in case you die, you're not there to help pay the mortgage, then you pay off the mortgage for that person. Interesting enough, I've had situations where one spouse would say, well, and most of the time it's men, so I don't mean to be beating up on the brothers tonight, but we have some problems with ourselves with it relates to economics sometimes. And they'll say, I'm not going to pay off no house so some other man can move in there with my wife. and I said, man, you'll be in heaven. Well, what you care about what's going on here on earth? You need to let that go and make sure your wife is squared away. What was the opposite and something happened to her? You don't hear her saying that about you because people expect men to remarry. Women have a little bit more pressure not to remarry. If that makes any sense to anybody, it certainly doesn't make sense to me, but I've heard it enough times where somebody says, I want to leave this money behind for my wife, but I don't want her to marry nobody else. I want nobody else living off my money. And I said to him, well, what makes you think your wife would marry somebody of lesser standard than her own self? And certainly he'd have to be a better standard than you because you are the one who provided for her. So she wouldn't take a step down. I don't believe that, but dealing with men can be interesting sometimes. So that's my piece on that. But you want to pay off the house. If you have children who are young children who haven't even gone to college yet, you want to make sure they can go. You plan on paying for it anyway while you're alive. So if you die, one, you want college to be paid for, and certainly one income would not be able to pay for it. And some people tell me even two incomes is a struggle to pay for college nowadays. It's so expensive. So you want to make sure that that's taken care of. The other thing is also if you're an adult and you have student loans, you want to pay off your student loans. Okay. You don't want the spouse burden with having your student loans. So you just simply have enough insurance to do that. And the last piece of this is the wealth transfer. Most folks don't know that life insurance passes income tax free. Let me say it again. Life insurance passes income tax free. So go back to the example I said earlier. You got $1 million worth of life insurance. You get that check free and clear, no encumbrances to that check. If you have a retirement account and you cash in somebody's retirement account after they die, you got to pay tax on that. And somewhere that tax could be upward to 30%. So, it's this life insurance piece starts looking really attractive in terms of wealth transfer. Not so great on the wealth accumulation side in terms of you, but in terms of wealth transfer for your family, it sets the stage. And here's the difference. Once one generation inherits an insurance policy of significance, then they understand the power of it going forward, and they communicate that to the next generation. Too often, our families have bought too little life insurance, and therefore it was insignificant. It meant nothing. Buying a $10,000 policy just to bury somebody is just a burial policy. It's not a wealth transfer policy. That's why we go back to this 10 times of your annual income. But here's what I would say. Buy a policy that you can afford to pay for. That's where you go. Buy the one you can afford to pay for and try your best to make sure it's the most amount of insurance I can get. Therefore, I'm going to take care of these other things, the mortgage and credit and whatever else that needs to be paid for, but I'm also going to provide a standard of living for my spouse or my children or whatever next generations to come. I'm going to do that. Next slide, please. So what happens as it relates to insurance? Most people are inaccurately insured. They mostly are inaccurately insured because I told you the starting number was 10 times your pay. Then I said throw in a mortgage and then throw in college costs. It could be upwards $2 million of coverage. Somebody says that's just too much life insurance. Well, if you're going to earn that much over your lifetime, what you're doing is replacing the income. How much am I willing to pay? The price of life insurance depends on 4 main factors: your age, your health. That's a big one. You could want a policy, but if you're not healthy, no insurance company is going to give it to you. The type of policy and how much coverage you buy. Now, somebody said, well, I saw on TV this commercial where they said you don't have to take no exam or nothing. That's the most expensive little policy that you'll ever pay for. Think about it. Why would an insurance company insure somebody for a lot of insurance who's getting ready to die? So they could just lose money. They don't work like that. They have to assess risk. And they write insurance off what they call the law of large numbers. That means if you have a pool of people who are mostly healthy, you can almost project the average life expectancy, and then you build a premium behind that. But there's one extra caveat that most people don't know about, and that is the insurance company counting on people paying for policies for long periods of time and then canceling them before they ever pay a death benefit. That's an absolute win, as I said earlier, for an insurance company. And I'll explain something to you how that has actually flipped on the insurance company, and people are seeing it happening right now in terms of their premiums on a different product. Again, what type of coverage do I need based on my needs? Again, varies amongst age. Younger people should be buying a lot more insurance than older people. Older people should have already paid off most of their debts and be heading to retirement. And again, they're not employed anymore, so they don't have to look at 10 times their earnings anymore to support their family. And normally they're pretty set at that point if they've done all the other planning that I've been discussing. Next slide, please. Disability income insurance. This is the one that protects your incomes to help you pay bills when you're able to work due to illness or injury or surgery. And what I'll just simply say to you is this. If you're a young person, your disability insurance is worth more to you than a life insurance policy. Let me repeat that. If you're a young person, your disability income insurance is more important to you than a life insurance policy. And when I say a young person, I'm talking about somebody who's under 50 years old. People have money saved for an emergency, but they never anticipate never going back to work at all. And when that happens, how do you pay your bills? You're not working, you run out of sick leave, you run out of vacation time, then what? Where's the check coming from? I've seen people who've been in bad car accidents, okay? Never go back to work. I've seen people who have heart attacks or strokes at young ages, never go back to work. They need to have disability income insurance to pay them when they are not able to work. Next slide. Long-term care insurance. I'm going to read this because we're in an epidemic in this country as it relates to long-term care. Almost, again, I believe everyone on this call has been affected by someone in their family having a long-term care event. So more than half Americans turning 65 today, more than half, will need some type of long-term care services and support. The average cost of those future services and support is $120,900. Think about that. That's over $10,000 a month. Most people have never paid that for a mortgage, much less paying for their care. These services include medical and personal care services at home or in a nursing home when people can no longer care for themselves independently. The average person will need these services for 3 years, and 20% of them will need help for 5 years or more. Women spend more on long-term care services than men because they tend to live longer. In addition, married women are often younger than their husband and are more likely to become widowed at older ages, leaving those women less likely to receive unpaid spousal care and more likely to provide for it. That means that they're going to pay for it to make sure they're getting taken care of. Oftentimes we hear people say, well, my children will take care of me. I always say, well, call them up and ask them. Call them up and ask them right now, will they take care of you? You got a child, he lives in Florida. Here you are living in North Carolina. You think your child going to quit their job and come home and take care of you? They got their own wife and kid or husband and kids where they are. They're not going to do it. You're going to have to figure out a different strategy. But to say you're going to put that burden on someone is unfair. It's unfair. So you need to come up with your own strategy. Expected long-term care costs are higher for women than men, $154,300 for women and $85,000 for men. Next slide. What triggers long-term care? Because people think long-term care is only for old people, but it's not true. It's about what they call ADLs, activities of daily living. When you can't do at least 2 of these 6 functions of everyday living, bathing, toileting, continence is being able to go to the bathroom, controlling your bowels, eating, dressing, and transferring. Transferring means getting from one room to another. Somebody got to help you get in and out of a bathtub, help you go to the bathroom when you got to go. That's transferring. Any 2 of those 6 activities of daily living are triggers for long-term care benefits or for care. There's one standalone by itself, which is dementia, Alzheimer's, or any type of head injury where you can't think as you would have normally thought. Those are cognitive impairments. And so what I would say to you is think about it. If one of these things happen to me, or do I know somebody had a stroke? Do I know someone who was in a bad car accident? Do I know someone who fell down? Do I know someone who just got old and started becoming feeble and couldn't do it for themselves? And now all of a sudden they got to have somebody come into their home to take care of them. Almost every client I have has already told me they do not want to go to a facility. They said, I want to have whatever care I get, I want it in my house. Well, you got to have money for that. You got to have money even if you go into a facility. If you're poor, it doesn't matter. Okay? If you're poor, it don't matter. If you go on Medicaid and you go to whatever facility will take you. But if you have some money, you can depict the facility you want to go to. And if you have insurance, you know it'll pay for it. Next slide. So there are a couple of solutions that relates to long-term care. You can buy a standalone policy, which means you buy a policy just for long-term care. It's a use it or lose it policy. Premiums are generally lower, but you are going to be subject to premium increases. And the reason for that is that unlike the other insurance policies I spoke of earlier, long-term care insurance has the least amount of lapses. People don't cancel their long-term care insurance. They keep it. And therefore, the risk to the insurance company has increased over time, and people are filing claims. So the insurance company has gone back to most states and been asking for premium increases over the last 10 years. Some premiums have even tripled from what they used to be. And lastly, there's no death benefit on a standalone policy. What we offer to most people is looking at a long-term care life insurance hybrid. Now I got a policy that will take care of my life insurance and take care of my long-term care all in one product. It's a no-lose policy. That means I'm going to die or I'm going to have an event, one of the two. So it's going to pay out no matter what. No premium increases. Premiums are locked. You can surrender it. That means you can come in 20 years after you bought the policy and say, listen, I don't want this policy anymore. And generally, you would get all the premiums back that you paid at that point. And then increased death benefit. You can actually have a long-term care policy where the death benefit will increase, not decrease. But most of them are going to be level. I mentioned earlier about policies that with a disability, and I forgot to bring it up during that slide. You can also buy some disability policies that have what we call a refund, a premium, or a good health benefit. That someone will say, if you have the policy for 20 years and you never filed a claim, they'll pay you back all the premiums or 50% of the premiums. No matter if they offer any kind of refund on a premium on a policy, you should take it, okay? And say that's a better policy than one that offers no refund of premium if I never file a claim. Next slide. The ABCs of Medicare. There's a lot of information going on this slide, but I'll just tell you this. I wanted you all to see all of what Medicare takes care of, because a lot of my seniors say, I don't need long-term care because Medicare will take care of me. I want you to take a look on there and tell me where you see Medicare saying it pays for long-term care. Well, you won't find it because it don't. The only time you'll get a Medicare benefit is after you've been in the hospital and you immediately come out of a hospital and you go to an assisted living facility or you go to a nursing home. And even then, it's a limited period of time that they will pay for benefits even there. So that's why I put this slide up, this ABCs of Medicare. I wanted you all who believe that Medicare covers long-term care to know it does not. It covers a lot of other things, but it doesn't cover long-term care. All right, next slide. All right, life insurance role in estate planning. Again, we're talking about wealth transfer. When I think about estate planning, the number one thing I think about is increasing the amount of money that somebody is going to inherit. This, again, is a sacrificial mindset. If you don't care about your next generation, pay no attention to anything I'm going to say. But if you care about your children or your grandchildren, or you want to create what we call some perpetual wealth, then estate planning is what you want to look at. You want to be able to pass on wealth to your family. You might want to pass on some to your church. I do a lot of that where I've actually written plans where people made their churches beneficiary of parts of their policies or all of their policies. I've even had some who have donated policies to their universities because they care about those things. They mean something to them. And so it's important that you understand that. If you are have a child with special needs, they're entitled to governmental benefits, but they still need a place to live. They still have a life that they want to live. You should want them to be able to travel and enjoy things, not just strictly live off the government dole. Well, you can set up a special needs trust funded with life insurance to make sure your special needs child is taken care of. People who have businesses and they have partners in a business, it's one of the partners dies. You want your life insurance to buy out the spouse of that deceased business partner, so you don't be haggling over the value of the company. You write this person a check, says the company's going to buy your share. You give me 100% of the company, and they're out. They love that versus people arguing about who can write checks, who can get checks, somebody in the cash register who don't belong in there, and so forth and so on. So we want to look at that. Next slide. All right, it's Q&A time. So I see there's some questions in the chat. If Bethany, if you can scroll up to the top line so I can make sure I get them all. All right, I see it. Okay. First question says, is the disability insurance in addition to employee short and long-term disability? The answer is sometimes. Yes, sometimes. Some employer plans on the short term, they'll pay 100% of your income for short-term disability. So you won't need it for that. But on the long term, which normally kicks in after 90 to 180 days, they're only going to pay sometimes 50 to 60% of your income on a pre-tax basis, which means you might only get 40 to 50% of what your normal take-home pay is. So you should be looking at supplementing your group insurance with a personal disability policy. The next question, let's see. Do I have any thoughts on borrowing from whole life policies to leverage it for other than business investments? I think you can leverage money any way that's needed with the proper guidance. So yes, leveraging whole life insurance, borrowing from it. I'll give you an example of a case we're working on right now. We're working on a retirement plan for a business owner. This particular business owner had $80,000 of tax liability. And we said, well, we can create a retirement plan that if you put $140,000 into it, it would erase your $80,000 deficit. He said, Ken, I don't have the $140,000. I said, yeah, you do. You have over $100,000 in the bank, and I see you got another $100,000 in your insurance policy. Why don't you take money out of both of those to fund your retirement plan? It's not like he's spending the money. He's actually redistributing the wealth and increasing his wealth by $80,000 by not having to pay the tax. Very, very clever when you can do it that way. But again, you got to have something already in place. But you can use the life insurance for a lot of things. Okay, next question. Will the long-term care life insurance hybrid policy cost more than a regular long-term care insurance? Yes, absolutely. Because you're covering two things instead of one. And you also are locking in rates, and you're also building up cash value in that policy. So it's what we call a trifecta with the hybrid versus a single element, just insuring for long-term care. Nothing happens, nothing comes back. Again, it's about affordability. I'm not saying one is better than the other. I'm simply saying it's an affordability issue. If I have the money to pay for a long-term care life hybrid policy, I should be buying that policy versus paying for one just because it's cheaper, the standalone insurance. Okay, next question. Uh-oh. I'm rolling through the questions, and we got looks like we got 8 minutes left for Q&A. Anybody want to come on and talk to me for a minute while we look and see if some questions come up? There we go, Dr. Weary.
So Ken, can you talk some about what is the usual process for getting the long-term care hybrid policy?
All right. So again, I'm going to treat everybody as if they've applied for a policy before. And that is, you got to go through an application process. All insurances require an application process. And during that application process, you're evaluated based on your health. And so when you think about a hybrid long-term care policy, think about the reason why this policy is in place. So it's when I can't do something for myself, like walk. I can't feed myself. I can't get to the bathroom. So if I'm already in those conditions, I'm probably not going to be able to buy a policy at that point. You want to get ahead of it and buy insurance when you're healthy. I always tell people when you have a lot of medical conditions, it's insurance companies either rate or they decline you from getting coverage. And so we want to make sure that you're at your optimum. The ideal age to be buying long-term care, Dr. Weary, is 50. That was where I like to see people look at it, 50 to 60 years old. Once you're over 60, the premiums start getting prohibitive, and it's a little tougher to buy. But if you have a lot of wealth, you can still afford it. But the question is, do I even want to pay for it? So recently, we did a contract on someone 65 years old. I'm not going to tell you all what it costs for the coverage because then everybody will hang up their phone on the call. Okay, but they had the wealth that they were trying to protect. You see, it goes back to this overall wealth protection. Remember, our whole theme is about protecting, creating, and protecting wealth. So if I have wealth, why would I want to spend out hundreds of thousands of dollars for long-term care insurance? Long-term care coverage, when I can spend tens of thousands for a premium for the same thing. And remember, it's all that money that I pay in a hybrid comes back to the family one way or the other through death or through the use of the plan. So no dollars wasted. No dollars wasted. Okay. All right. Thoughts on having a trust on the policy as in an ILET. Isn't it better to get these while young and can pass underwriting, but salary is low? Well, again, it's your strategy at that point. If you're a young person and your salary is low, are you going to really be buying a big enough policy that it needs to be in a trust? The only reason it would be in a trust is if the person who you send as beneficiary, you believe they can't manage money and you need somebody to manage it for them. And that's why having it in a trust is important. You don't have estate tax issues, okay? You're not going to have creditor issues. So it should not be an issue where it needs to be in a trust. But if you're more affluent and you have some issues with heirs that you say they can't manage money to, I want to make sure that money's away from other business interests and so forth, then a trust would be adequate and the right thing to do. Age-wise, there's really no age about trust. It's really about your fluency and everything else that you're trying to do. But certainly the earlier you put together your estate plan, the better off you are in doing so. All right, next question. All right, we've got 3 minutes.
Ken, I don't see any more in the chat.
Okay.
Maybe you want to just tell everybody how to reach you?
Yes. Next slide. There we go. So if you want to connect with me, there's my website. We have like lots of articles and things on the website that you can peruse. We put out several topical questions throughout the course of the month on our Facebook page. We always are putting articles out about different topics or different things that are going on. Matter of fact, this month, I believe, was long-term care insurance month. So that was one of the things that we would have already put some stuff out on. We also have a YouTube channel as well. And I didn't put that up there, but I think you can get it off of the Facebook or the website where we do normally 5 to 7 minute topical information on various different topics throughout the course of the year, myself as well as my other associates. So you see my phone number there. You see my email address and my web address is there. So easy to reach. Everybody knows that I'm very easy to reach. One of the things that people tell me that they like about our firm is that we will get back in touch with you quickly. We always do. And it's very personal when we get back with you. Our whole staff is very a loving group of people. And I said this before, 90% of our clients happen to be African-American. It's a calling, it's a ministry for us. Someone asked me, you know, how much money you have to be served by us. And I said, I don't care what you have. If you want us to serve you, we'll serve you, but be faithful to us. You know, don't call me up and tell me something that somebody else told you versus what I'm saying. I'll just tell you, go listen to the other person. Okay. Because that's just not a way that we want to operate. We want to make sure that people know who we are and that we do take care of our own. As you said earlier, Dr. Weary, we have a reputation to uphold and we do it well. We like doing that. Thank you, Bethany. Thank you, Bethany.
Hey, thank you so much. Reverend Sims, you want to come in and lead us out? Thank you, Brother Ken, for, as usual, being a blessing.
Yes, this was so good. A lot of information. And I just want to let everybody know that Mr. Royster is licensed in many, many, many states. And so he's also licensed in North Carolina and South Carolina. So if you need him to help you with any situation that you may have, please feel free to go to the website and start your plan, because, you know, there is a period right now where we can have some wealth transfer. You know, there's a time right now that if we can have some money set aside, I can't wait till the next session where he's going to talk about 401ks, you know, just investing in the stock market, things like that. So we want to pay attention, because this is the time right now where we can have some wealth transfer from where our parents came from to where we are starting from. And there's a lot of young folks that's making mega money, but are they saving it in the right place? Are they putting it in the right investment strategies? And so he is your man to help you with any plan that you have need help with. So stay tuned. We're going to give you some more information. Tell your children, tell your grandchildren. If you're old enough and you got great grandchildren, let them, send it to them, share, tune in, because this information is life-changing. So we thank you so much, Mr. Royster, for all your information. You have educated us a whole lot. I took some notes, so I'll be looking at my notes.
Thank you. Just for everybody, I don't think we're coming back in December. So everyone have a great Thanksgiving, a Merry Christmas, and a Happy New Year. And we look forward to seeing you in January. All right. Take care. All right.
Thanks a lot, everybody.
All right. Bye.